Hello and welcome. So, being the part of a financial modeling, now it's time to understand the financial planning analysis. Before moving forward, and if you have seen the financial modeling analysis fundamentals, you would have understood that there are three important statements. First one is the profit and loss statement, or you say an income statement. Second, we have a balance sheet or statement of financial position. Third, we have a statement of cash flows, or we can say a cash flow statement. Now it's a time for financial planning analysis, and this time we're going to start with some frameworks and guidance. In this way, the first thing we need to understand is about the financial performance, or you can say the profit and loss statement, and its presentation for financial modeling as well as financial planning analysis. There are the number of ways in which we can present our profit and loss statement, and each way explain different perspective for financial modeling as well as financial planning analysis. In this session, you're going to learn and understand those in depth about the presentation of a profit and loss. So this is very important for the financial planning analysis analysts or managers as well as the financial modelers. I hope you will be enjoying this session. If we see further, let's start. What's the first thing we're gonna see it? Here, it says presentation of profit and loss statement. On the left hand side, you can see an infographic which explains the different variations, which explains the different types of presentation of a profit and loss statement. We need to understand it side by side, and this would be explaining very deeply for the financial planning analysis as well as for the financial modeling. If you see and what it explains, what I thought for this, we need to understand those. Let's just see the basic history or background for profit and loss statement. It explains understanding the various methods of presentation of a profit and loss statement is critical both for financial planning analysis, professionals, and financial modelers. Yes, as it's an important component of financial model, it's an important component of financial statements. So we need to understand it in a deeply. There are various methods of understanding. Each method serves specific purposes and provide different insights into the company's financial health and performance. Yes, each type explains a different type of performance, and each performance explains different health. Here's how you can use these methods and explain for the financial planning, analysis, as well as financial model. First one is the accrual basis. What are its uses in financial planning analysis? First of all, we use accrual basis for budgeting and forecasting. Financial planning analysis professionals rely on accrual data to create budgets and forecasts that aligns with the company's financial objectives. So you prepare the budgets, you prepare the forecasting. Actually, the budgets are also the forecasting. It's not actual result. It's just an estimation. And estimations can't be 100% true. You know, need to understand that. Forecast budgets are just the same thing. They are just the same thing. There's a little bit difference, but in a way of presentation or explanation, you can use a similar way interchangeably. It explains that this method ensures that the forecast reflect true economic events, not just a cash flows. Yes, in a forecast, we're gonna see each line item economic events, each line item presentation, how this line item would be shown in actual way. We don't understand or we don't focuses on a cash flow yet. We need to understand that. So accrual basis, and if I go into zoom mode and show you what does it explains and how you can show it. Accrual basis, as you can see in infographic, you start an income statement from a revenue, as you know that, and you record a revenue when it occurs when you deliver the goods or services. They are the five-step model being explained in IFRS 15. I'm not going into the deep towards the IFRS 15 because this would be moving towards the financial reporting, and we are not covering financial reporting. We are learning financial modeling, and in this financial modeling, we have some understanding of financial planning analysis. For this, we need to understand the profit and loss statement into the deeply. Previously, we understood what is an income statement and how its importance analysis. This time, we're going to see the presentations. Each lecture is very important. On accrual basis, I hope you understand that you record your revenues when it has been incurred or when you deliver the goods. And the expenses when those are incurred, you don't see the cash basis. Whenever the cash receives, you recorded cash entry. I'm not going back toward the basic journal entries or basic accounting principles if we are working in the IFRS, International Financial Reporting Standards, or if we are working in the US GAAP's generally acceptable accounting standard and presentation. You need to understand that. So, what is the second use of in FP&A? It explains that it is accurately used for the measuring of performance. Accrual accounting provides a more accurate measure of a company's financial performance by matching revenues with expenses incurred to generate them. This is a critical for analyzing profitability and making long-term strategic decisions. Yes, if you have understood that how you create a budget, how you create a forecast, then you would be understanding the use of budget and forecast for measuring the performance. You use budgets and forecasts. You use financial models for your presentations. Alright, we understand and for measuring the performance. By measuring the performance, we need to understand some of these things. We measure performance using the ratios. In the next session or in the next module, you have a third module called financial analysis. That would be including our different types of ratios, profitability ratios, liquidity ratios, your solvency ratios, your investor ratios, some other important ratios related to your profit and loss or an income statement. These ratios and their presentations helps in making the long-term decisions. It has been explained that here the long-term decisions are the strategic decisions. Yes, what is meant by strategic decisions? So you as a board member, I'm considering you as a user or you as a presenter or a board member. So as a board member, you work with your team to develop the long-term decisions. For the long-term decisions, you create some strategies. There are the number of strategies available in your business leaderships. You need to understand those strategies side by side and implement those in your practical working. Those strategies are very helpful. For the strategies to be implemented in a good way, and as a FP&A manager, you need to prepare the financial model. For the financial model, you need historical information, your previous year or a last year information, your current year results, and your future results. How you predict, how you forecast the futures, it's just based on your trends. Another new thing has been explained, a trend. That will be explained laterly, as you can see here. I hope you have understood the accrual basis and its use in financial planning analysis. What are its bases or what are its uses in a financial modeling? So first of all, we use accrual basis for the valuation models. As you know, there are multiple valuation models. First of all, very important for decision making, for investing, for investment decisions, for the long-term presentations, for the long-term strategic decisions, we have a very important essential type of valuation model. It's called DCF, or you can say discounted cash flow models. For the discounted cash flow model, we need the profit and loss statement as well as the cash flow statement. I'm just briefly explaining the valuation model now, but in a future, in a coming session, you will be learning discounted cash flows as well. There is a case study of a DCF modeling available, and there will be case study on international investment appraisals. You will be working for international currencies and converting those currencies in your local and calculating your DCFs, discounted cash flows for the decision makings. As in valuation models, it explains accrual accounting is essential for building discounted cash flows where accurate revenues and expenses recognitions are crucial for projecting free cash flows. Yes, First thing, you need to create an income statement. Your income statement comprises your revenues and expenses. It says you need to record an accurate revenue and expenses. We agree. Next thing, after revenue and expenses, we need to see further things. Which are the further things we need to prepare the cash flows, how those cash flows are being linked towards my income statement. Then the third thing, your cash flows, your income statement are very important for projecting or for calculating your free cash flows. Your cash flows are very important for decision making as well as your strategies development. Your free cash flows are very important for investors, for capital investors, for the users of financial statements to see how much company has a free cash available for any they need. Those are being projected after your income statement and after your cash flows. You discount your cash flows to see the present values of your cash flows. Next thing, it's used in a financial modeling, it's sensitivity and scenario analysis. It helps in conducting analysis based on realistic assumptions about revenues and expenses, allowing modelers to simulate different scenarios. You prepare different scenarios and you got to see each scenario different result of revenue as well as the expenses. I'll be showing the practical way in a later after completing your theory. You'll be understanding how the scenario analysis works. We will be preparing sensitivity as well as the scenario analysis. We have a case study of three statement modeling that would be including scenario analysis. There's a separate case study available for sensitivity analysis as well. So, as an income statement is learning and linking, you will be changing your revenue drivers, your expenses drivers, and getting an opposite result to your actual basis. The best practices suggest there are the three scenarios available: the base case, the best case, and the worst case. But you are learning the advanced financial modeling as well side by side. I hope after the learning you will be able to give the exam of FMI Canada. So you're gonna develop some further cases as well. You can name those cases whatever you need to see, your choices as a financial model, but developing more scenarios would be getting different output results, would be increasing your decision making. Next thing, we have a cash basis. So you record your revenue and expenses on a cash. As you receive the cash, you debit your cash and credit your revenue. If you incur an expense, that expense would be debit your expenses and credit your cash. You are looking towards the cash flow side by side. So your profit and loss and the cash flows are moving side by side. First use in a financial planning analysis, it explains the cash flow management. FP&A teams uses a cash basis statements to monitor company's cash position, ensuring that there is enough liquidity to meet the short-term obligations and manage working capital effectively. So, you work for the short-term development of a company that is called working capital. You manage your short-term obligation or liquidity or liabilities using your cash. FP&A team look towards the cash flow. Cash flow is very important in FP&A. And if you are preparing your income statement on a cash basis. Next, you have a liquidity analysis, understanding your cash inflows and outflows. It helps for you the planning your debt repayments if you have any capital expenditures. Capital expenditure means you purchase an asset, you purchase an investment property, or you purchase a long inventory. Your inventory is also a capital expenditure, but you record an inventory as a separate thing according to IFRS. Its accounting standard is IS2 and other significant cash commitments. I hope you understand this. And what are its uses for the financial modeler or financial modeling? You help the cash basis for your cash flow projections. Cash based accounting is crucial for modeling, focuses on cash flow forecasting, particularly in a cash flow statement. which are the integral for assessing the liquidity and financial flexibility of a company. So, you prepare cash basis of your income statement, and that cash basis income statement is linking towards the cash flow statement and how that works. You understand those in a financial model. When we gonna prepare the three statement, all of this theory will be side by side answering all of your questions in your mind. Bank covenants compliances. Financial model often include checks for compliances with the debts covenants, which are frequently based on a cash flow metrics. Yes, sometimes you get an overdraft in a bank for the short term period, and that cash flow projections would be helpful for your bank covenants payments and how those payments are being covered if you incur the revenue. You are working on a cash basis. Next, we understand by the class basis. So first of all, it explains the segment reporting. Your IFRS 8 operating segments are being explained here. FP&A analysts or professionals use the class-based P&L to analyze the financial performance of a different business units or a product lines. It helps in resource allocation and strategic planning. So, if you're an organization have multiple segments available, they would be preparing separate segment reports according to IFRS 8. After preparing the reports, they would be getting a consolidated or a merged report for your decision making to the CFO or CEO, whatever they operate to CEO or a COO. That would be very helpful for the strategic planning. That would be very helpful for the resource allocation as well. And you would be looking at which segment is more profitable, which segment is more workable. You'll be understanding that as well. After consolidating, you'll be getting a single segment report that would be used for the advanced decision making. Why I talked about the advanced decision making? Because in advanced decision making, you're gonna look towards the forecast and you're gonna add the budgets as well. It explains secondly about the profitability analysis. You understand that after a segment report, after your segment profit and loss, you need to calculate, you need to understand each segment profits, each segment analysis, and then you can make informed decisions about your investments. Your restructuring represents the company's capital structure or the liability structures. Profitability. So if one segment gross profit margin increases, another segment gross profit margin decreases, but its net income margin it increases. Now it's a crucial point to understand which segment to be focused on first and which segment to be focused on later. Which segment reports more time to for understanding and which segment reports less time for understanding its operations. All of these things are going to look into the detail for your financial planning analysis. In the uses of financial modeling, you get to see segmented financial models. Yes, after preparing your financial model, you prepare each segment financial model. Yeah, for the small and medium enterprises, you prepare a single financial model. But if you move towards a large organization or any exception to SME, which prepare or which makes different segments, then you would be forecasting each segment business unit performance. You will be projecting its performance. You'll be projecting its expenses, its assets, its liabilities, and getting a segmented financial model. You're preparing each segment scenarios to get a detailed analysis of your business. You need to understand these side by side. I hope you are learning very effectively with me. At this point, you have only understood the three presentation types of your profit and loss statement. First of all, you understood the accrual basis. Second, you understood the cash basis. Third, you learned the class basis. What is the fourth thing? You're gonna learn about your monthly income statement, its presentation, and what are the uses in financial planning as well as financial modeling. I hope you are learning side by side, and don't forget to share with others. Nextly, you prepare your monthly for the short-term performance tracking. Your monthly profit and loss statement enables FP&A team to monitor your performance closely and make a timely adjustment toward the budget and forecast. Yes, it's about the time and requirement of your team to get a annually budget to get your quarterly or monthly budget. That budget or a forecast helps you to get a decision making for the short term period. What is trend analysis? Monthly data is crucial for identifying trends, seasonal patterns, and variances that can impact financial performance, allowing for more accurate forecasting. So, your trend analysis helps you getting more deeply financial performance. In Excel, you have a quick analysis, Control plus Q quick, and if you press those keys, you'll be getting a list of analysis available, whether to do a line chart, graph chart, or whatever the chart you choose, and it gives an instant analysis. You have a sparkling analysis, very important for your trend analysis. Side by side, I'm explaining you about the Excel as well. That's a good thing. Uses in financial modeling. First of all, you prepare your rolling forecast, your monthly data, which rolls over 1 year, 2 year, 3 year. That is called rolling forecast model, and it provides you up to date and accurate result. Your variances are also being very deeply analyzed if you prepare your monthly comparisons. What are the annually? So your annually are being used for the long-term plannings. First of all, annual profit and loss statements are essential for the strategic plannings. You set your long-term decisions, long-term goals, and try to objective try to get over those goals for the long term for that fiscal year. However, your long-term planning doesn't goes for the for 1 year, it moves for the 2, 3, 4, 5 years. Moreover, as a financial modelers, you prepare a 5 year or 6 year financial model. As here has been explained below. In evaluation, a long-term model uses a financial model. Each thing has been linked with each other. Your executive reporting, it provides a high-level summary of a year's financial performance, which is often used in reports to senior management, boards, and shareholders. So, you prepare an executive report as well, which is at the end of your financial model, and that has been comprises your annually result, your quarterly result, or monthly, whatever your requirement. Currently, we are learning and understanding the annually requirement, so we prepare annually reports and report them to the senior management. Your long-term decisions are very helpful for the executive reports. However, if you have seen the reports of any long company, a large organization, you would have seen a director report first or a chairman report. Then you would have seen any other important board director report. That would be your executive reporting. All these reports have been included in your financial statements. If you see Unilever financial statement, if you see your Coke, Pepsi financial statement, you will be getting an executive report at the first and then your financial statement laterly. You benchmark your annual results with your forecast, with your previous year performance or historical result and see what are the changes. Sixth way you understand for the quarterly workings, you prepare your midterm analysis, you prepare your semi-annually workings, and you got to see each quarter result, how each quarter performs, bad or good. Your FP&A team analyze those very deeply. They look towards the EBITDA, they look towards adjusted EBITDA. They're working for the notepad. I hope you understood the notepad, or if you have a new term, understanding it is being called net operating profit after tax. We have a case study on notepad as well and a session on a notepad as well. Don't worry, in just a few days, you're gonna understand the notepad as well. Next, you have a uses of financial modeling for the quarterly in interim financial reports and financial forecasted. You paid interim forecasted, you got a quarterly data to update the financial model for the mid-year, allowing adjustments on basic performance and economic conditions. So your quarterly results helpful for your economic conditions of a company. Seasonality analysis. Quarterly figures helps in identifying a modeling seasonality which can significantly affect revenues and expenses patterns. So seventh is very important. You prepare your profit and loss as a percentage of your revenues. You prepare your profit and loss on the basis of revenue. Revenue is your line base for the percentages. First of all, if we see toward the FP&A analysis, you got to see the margin analysis. It expresses the costs and expenses as a percentage of revenues, helps in understanding the company's cost structures, margin profitability. So if you have understood previously or if you have read about the financial analysis, there's a certain type called vertical analysis. In the vertical analysis, you prepare a significant portion as a percentage of revenue. But here, if you're presenting profit and loss as a percentage of revenue, now you are preparing a detailed margin analysis. Benchmarking efficiency metrics. This method is very useful for comparing companies' efficiency and profitability against the industry peers, identifying its area for the cost reduction or optimization. You prepare percentage of revenues statement for your cost reductions. The COO, Chief Operating Officer, will be looking towards how you can reduce the cost, and that significant presentation of profit and loss will be very helpful for it. You understand financial modeling working, so you got to prepare the cost structure modeling. Model often include the cost as a percentage of revenue to stimulate how changes in revenue affect the profitability. Here it has been mentioning that your revenues affecting your profitability, but your cost as a percentage also affects your profitability. If your cost increases, then your revenues, then your profitability ratios will be decreasing. And again, you got to look sensitivity analysis. So you can't run out before or after. You can't run from sensitivity analysis. Sensitivity analysis helpful in testing your each revenue driver, each cost drivers, and get a change in your profitability, get a change in your investing, get a change in your solvency as well as the liquidity working. Eighth thing, you're gonna look toward the back category, each category working. As you see, you got to explain your expenses in a list such as marketing expenses, such as advertising, or you can make any expense list as IS1. Now IS1 is being changing toward the IS 18. It has been a list of an expenses available. You prepare a list of an expensive, you prepare a list of revenues you earn, and prepare a detailed income statement for the decision making. If we look toward the uses in financial planning analysis, first of all, we understand about the expenses management, categorizing expenses such as payroll, advertising, research, and development. It helps in managing and controlling the cost. All right, it makes it easier to identify areas for the potential savings. You save for your futures, you save for the next years, you allocate your budget according to your category, and category wise profit and loss is very important for your budget allocation. It is very important for the forecasting as well. It is very important for the strategic decisions whether this expense should be decreased or if we have to cost cut apply, if we have to apply some activity based budgeting decisions for my expenses controlling. Uses in financial modeling. So you use category-wise financial decisions, category-wise profit and loss statement for the detailed cost analysis. Financial models often break down the cost into the categories to project expenses more accurately and assess the impact of changes in special cost drivers. Yes, each cost drivers can be expensed out, can be detailed out in a category-wise, and can give you informed decisions. Here you prepare scenarios and you got to see each scenario results which have an impact on your profitability. You cannot forget your profitability. Your profit margin as a profit percentage of your revenue, that would be very important key metric for each category, for each type of presentation and decision making. In a line, we look profit and loss statement by the department view, we look toward the resource allocations, and we understand the departmental performance management, how it provides an insights. It explains provide insights into how different departments are performing. It is critical for managing budgets, performance reviews, and incentive structures. So you manage your budgets, you manage your performance reports using the departmental profit and loss statements and get a decision. There's, I hope, no difference between the segmental profit and loss statement or by class profit and loss statement by category wise, but each category or each way of presentation have its own benefits. There are some pros and cons, but you need to understand that. So this is being using for the resource allocation. You can understand the which department needs your resources in a large way. You use your financial models for budgeting. For department budget model, you have a cost center analysis which helps you analyzing the cost, projecting the cost, forecasting the cost. It is associated with each department. So each department earns the revenue, and earning that revenue, you incur some costs and expenses. Those costs and expenses are sometimes overhead costs, sometimes admin expenses, and those costs can be cut using the cost center analysis that has been used is for the performance managers, for the project managers, and for the financial modelers as well. You compare your profit and loss with the last year and present that. That helps you in a trend analysis, that helps you in a performance evaluations. You use your financial modeling techniques for the short-term variance analysis. You use your financial modeling techniques for the growth projections. You project your growth for the period over period change. And if period over period change requires your last year comparison, last month comparison, or last quarter comparison, you need to do that. That is very helpful for the trend identification as well. Your waterfall chart in Excel is very helpful for this. Your column chart or a bar chart is also very helpful for this. You compare your profit and loss with the budgets and present those. Though budgets are the very first type being explained as a variance analysis, comparing actual results to the budgets, which helps in identifying the variances, understanding their causes, and making necessary adjustments to future budgets. You prepare the last year budget and you prepare the current year budget. You see the variances between the both budgets and compare those budgets with the actual results, which helpful for the informed decisions and which are helpful for the strategic planning as well. You accountable your performance, you account your performance as well. Your performance of a factory working, your performance of a manufacturing unit, your performance of a cost center, and you got to see the result. Uses in financial modeling, you use your budgets for the forecast revisions, you use your budgets for actual versus forecast comparison and getting a decision. You use your budget for the scenario analysis as well. And in the lastly, you compare your year over year result, you compare your year analysis for the strategic planning as well. Your strategic planning helps in evaluating the long term strategies and helps in making your informed decisions. Sometimes your year over year analysis is very helpful for understanding the growth, understanding the seasonal performance, and helps you to see the long term trends. So, as an analyst, as a financial planning analysis manager, yet I'm working as a financial planning analysis manager, I will be looking toward the last 3 years year over year growth and will be comparing my current year growth and getting a decision. You have your AI tools, you have your Excel or any FP&A tool, and that will be very helpful for your strategic planning as well as your year over year analysis. When you look toward the financial modeling, you have a growth trend analysis using the sparkling analysis or using a bar chart, column chart for the Excel analysis. You benchmark your industry best practices, you benchmark from your competitors to get our decisions. You use your historical analysis as well, your historical results. As I previously mentioned, my 3 year year-over-year result would be helpful for the projecting my future models. I hope you understand very well about the presentation of profit and loss statement. I'm ending this session and we're going to learn furtherly. There are some further frameworks for understanding the profit and loss presentations, for understanding some EBITDA presentation or EBITDA result for the financial planning analysis. There are different profit and loss statements side by side we explained and those presentations in our case studies as well. Don't forget to watch my sessions and be enrolled in FMVA course. Thank you.